Japanese candlestick trends. There are three main types that determine the direction of candlesticks, as if they were the words spoken by the candle to the trader. Trend continuing candles. These are candles where the body is larger than the opposite direction wick, or the opposite direction wick is shorter than the trend direction wick, and the candle color aligns with the movement direction. For example, in an uptrend, if a green candle appears with a body larger than the upper wick, the opposite direction wick in an uptrend, this indicates strong buyers or weak sellers, or both together, suggesting a continuation of the upward movement. Similarly, if a green candle appears where the upper wick, the opposite direction wick, is shorter than the lower wick, the trend direction wick, this also signifies strong buying pressure or weak selling pressure, or both together, favoring a continuation of the uptrend. Reversal candles. These are candles where the body is smaller than the trend direction wick, or the opposite direction wick is shorter than the trend direction wick, and the candle color is opposite to the movement direction. For example, in an uptrend, if a red candle appears with a body smaller than the trend direction wick, the upper tail or upper wick, this indicates weak buyers or strong sellers, or both together, suggesting a potential trend reversal and a downward movement. Similarly, if a red candle appears where the lower wick, the opposite direction wick, is shorter than the upper wick, the trend direction wick, this indicates strong selling pressure or weak buying pressure, or both together, favoring a trend reversal and a downward move. Neutral candles. These are candles with a very small body, or sometimes no body at all, and a wick that is longer than the candle's body. The candle's color does not matter. When a neutral candle appears in an uptrend, downtrend, or sideways market, whether red or green, with a small body or no body at all, it signifies an equilibrium between buyers and sellers. Such candles are not useful for making trading decisions, as they indicate a continued struggle between buying and selling forces. In an uptrend, the appearance of a neutral candle suggests a slowdown in upward momentum. In a downtrend, it signals a temporary pause in the decline. In a sideways market, it indicates a likely continuation of the range-bound movement. Professional traders typically postpone their buy or sell decisions when neutral candles appear. Patterns you should know. Candle patterns refer to the formation of one or more candles with specific characteristics. These patterns provide signals and meanings depending on their location on the chart. There are many well-known patterns, and we will cover the most important ones that traders should be familiar with, as they help in understanding market behavior. These patterns have commonly recognized names to make them easier to identify and explain. Hammer candle. This is a reversal candle that appears in a downtrend, signaling a potential end to the trend, a end, and a possible reversal. It consists of a candle with no upper wick or a short upper wick, the wick opposite to the trend, a small body, and a long lower wick, the wick in the direction of the trend. Ideally, the hammer candle should be green, opposite to the prevailing trend, as this strengthens the reversal signal. However, if the hammer is red, in line with the previous trend, it is still valid but considered a weaker signal. Some traders refer to a red hammer candle as a hanging man. You should take into consideration that candles do not necessarily have to follow a fixed and uniform pattern. Instead, they often appear in very similar shapes, allowing you to recognize and identify the candle pattern when you see it. Inverted hammer candle. It is a reversal candle that appears in an uptrend, signaling a potential end of the trend and a reversal. This candle has no lower shadow or a small lower shadow, a counter trend shadow, a small body, and a long upper shadow, the trend shadow. It is preferable for the candle to be red, opposite the trend, but it is also acceptable if it is green with the trend, although it would be a weaker signal. Engulfing candle. It is a continuation candle pattern consisting of two candles with opposite colors. It has a bullish formation in an uptrend and a bearish formation in a downtrend. In an uptrend, the pattern appears as a small red candle followed by a larger green candle that completely engulfs the previous red candle. The high of the green candle must be above the low of the red candle, and the green candle's closing price must be higher than the red candle's opening price. This pattern indicates the continuation of the uptrend. In the case of a downtrend, the pattern appears as a small green candle, followed by a larger red candle that completely engulfs the previous green candle. The low of the red candle must be lower than the low of the green candle, and the red candle's closing price must be lower than the green candle's opening price. This pattern indicates the continuation of the downtrend. The inside candle. Pregnant candle is a trend continuation pattern consisting of two candles of opposite colors. It has a bullish form in an uptrend and a bearish form in a downtrend. In the case of an uptrend, the pattern appears as a large green candle followed by a smaller red candle. The high of the red candle does not exceed the high of the green candle, and its low is higher than the low of the green candle. Additionally, the red candle's closing price must not be lower than the opening price of the green candle. This pattern indicates the continuation of the uptrend. In the case of a downtrend, the pattern appears as a large red candle, followed by a smaller green candle. The low of the green candle is higher than the low of the red candle, and its high does not exceed the high of the red candle. Additionally, the green candle's closing price must not be higher than the opening price of the red candle. This pattern indicates the continuation of the downtrend. The morning star pattern is a bullish reversal pattern consisting of three candles. It appears at the end of a downtrend or sideways movement and signals a potential upward reversal. The pattern begins with a large red candle, followed by a very small green or red candle or a doji, and concludes with a large green candle whose closing price is at least above the midpoint of the first red candle. The evening star pattern is a bearish reversal pattern consisting of three candles. It appears at the end of an uptrend or sideways movement and signals a potential downward reversal. The pattern begins with a large green candle, followed by a very small green or red candle, or a doji, and concludes with a large red candle whose closing price does not exceed the midpoint of the first green candle. The strength pattern is a trend continuation pattern with a bullish form in an uptrend and a bearish form in a downtrend. In an uptrend, this pattern consists of 3 to 5 consecutive green candles followed by a weak red candle, which is smaller than the last green candle and does not close at the lowest price. This pattern indicates the continuation of the upward trend. In a downtrend, the pattern consists of 3 to 5 consecutive red candles followed by a weak green candle, which is smaller than the last red candle and does not close at the highest price. This pattern indicates the continuation of the downward trend. The market error pattern is a reversal pattern that has a bullish form in a downtrend or sideways movement, and a bearish form in an uptrend or sideways movement. It often occurs after a deceptive move in one direction before reversing in the opposite direction, a trap. In an uptrend, the pattern consists of a single strong and large red candle, indicating a rush and acceleration in selling from high levels. This candle is larger than the last green candle, or even two or more preceding green candles. The pattern suggests that the market is correcting a pricing error and signals the beginning of a correction. In a downtrend, the pattern consists of a single strong and large green candle, indicating a rush and acceleration in buying from low levels. This candle is larger than the last red candle, or even two or more preceding red candles. The pattern suggests that the market is correcting a pricing error and signals the beginning of a correction.